Welcome and thanks for joining this quick investment video. I'm Bramwell, a member of Heimerberg's investment team, and I'm going to spend just a few minutes discussing some of the drivers that have been pushing us to higher yields, especially on the longer term end of the yield curve. When the Fed began its rate hiking cycle, short-term bond yields, such as a 3-month Treasury yield up to the 2 or 3-year Treasury yield, rose as a direct consequence of the Fed hiking the Fed funds rate, which would be completely expected. Here we can see that on the left-hand side with the 3-month Treasury bill up to the 2 or 3-year Treasury, and we can see that over the last year that the short-term rates have risen significantly. The sharp and significant rise in short-term rates led to an inverted yield curve, which occurs when shorter-term rates are higher than the longer-term rates. This measure is often used as a recession indicator. However, in recent months, we have begun to see longer-term Treasury yields, such as the 10, 20, and 30-year Treasury yield, move higher, while shorter-term yields have barely budged. Here we can see this on the right-hand side, where longer-term yields have risen in the last few months. To help us better understand where yields may go from here, let's discuss a few of the drivers that have recently been pushing up yields. First, let's consider that the Fed's goal of raising rates is to tighten monetary policy to slow the economy. The Fed has long stated that it believes that a period of below-trend growth is needed to push inflation back down to its 2% target. However, the federal government has not been on the same page. The federal government has continued with additional spending programs which have doubled the annual deficit in 2023 to around $2 trillion when looking at a cash basis. Additional government spending, when the economy is already at full employment, tends to be inflationary and would support higher yields since the spending supports future economic growth. These programs would include last year's passage of the CHIPS and Inflation Reduction Acts. The CHIPS Act provided roughly $280 billion in new funding to boost domestic research and manufacturing of semiconductors in the U.S. The Inflation Reduction Act included $663 billion in the law's climate action investments that are embedded in the federal tax code. Second, and related to government spending, is that as the U.S. deficit continues to rise and has become a focus of investors due to the increasing political gridlock in D.C., those combined issues led to the downgrade of U.S. debt rating by another agency this summer. It was much easier to build deficits when interest rates were at zero versus when government debt is now issued at rates of 5% or higher. That could lead foreign investors to demand a greater yield to hold treasuries, pushing rates higher. In addition, the deficit leads to an increasing supply of treasury bonds that must be issued. We have seen this occur this summer and fall, which is putting an upward pressure on rates. Next, the economy has been stronger than expected, given the unprecedented rate hikes by the Fed. The job market remains strong. Consumer spending has held up. U.S. GDP estimates are still positive, indicating the economy has been and still is resilient. Stronger economic activity tends to correlate with higher yields. Longer-term yields have moved higher as the much-anticipated recession of 2023 has continued to be pushed off now until probably sometime in 2024 at the earliest. The manufacturing sector, which accounts for only about 8% of employment, has been in a severe slowdown since late last year, as the Fed's rate hikes cooled the interest-sensitive sectors of the economy, such as housing, autos, commercial real estate, and manufacturing. But service sector spending, which is less sensitive to interest rates and constitutes about 78% of GDP, continues to show strength even as economic growth has slowed. Fourth, is that outside of the U.S., several countries are reducing their holdings of U.S. dollars and are selling U.S. treasuries. This move has decreased the number of global buyers and therefore the demand for U.S. treasuries. This decrease naturally leads to lower bond prices and higher yields since they move inversely. So fewer buyers at the same time our supply has been increasing. Again, this demand dynamic will put upward pressure on yields. On top of this, the Fed has now reversed course and is shrinking its own balance sheet at about $100 billion a month. The last factor I'll mention is also related to supply and demand. Among the largest holders of U.S. treasuries are U.S. banks. The commercial real estate crisis has created a capital problem for banks, especially the regional banks. Banks are under increased scrutiny from regulators to decrease their exposure to certain sectors of real estate and to raise liquidity. These pressures mean banks could be forced sellers of treasuries, which are likely the most liquid asset the banks hold. Again, this just adds supply at a time when there are fewer buyers in the market, which puts upward pressure on yields. The Fed's main tool to stimulate or restrict the economy is by raising or lowering the Fed funds rate. We can see by this short discussion of just a few of the factors that can move yields that many factors are out of the control of the Fed. Given the persistence of the Fed to see a decline in economic growth to get inflation down to its 2% target, we believe that slowing leading economic data, coupled with higher interest rates and tighter lending conditions, indicate an elevated risk that the economy will slow over the next few quarters. We also believe that stock returns will face headwinds given the stock market's current elevated valuations. We are closely watching earnings guidance to support those valuations as we get closer to 2024. We have positioned portfolios accordingly with a slight underweight position in stocks and an overweight exposure to high-quality short-term fixed income investments. We believe it makes a lot of sense for investors to hold within their bond allocations exposure to very short-term bonds, and collect the higher attractive yield, which we are currently doing. But we also think it makes sense to have some exposure to managers that have more duration as the Fed is closer to ending its hiking cycle and given the elevated risk of an economic slowdown over the next year. Given the uncertainty of how high the Fed will ultimately hike and for how long they will stay there, we believe some diversification without sacrificing the yield component makes a lot of sense right now. Thanks again for watching this quick investment video. If you have any further questions, please reach out to a member of your client service team. Thanks again.